Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar and all our shows are for informational purposes only concerning Market Chameleon tools and products. With that, D, good morning, my friend.
Good morning, Will. How are you?
Good.
Good morning, everyone. I'm going to share my screen here. And today we'll cover how to look up in options trade time and sales. So I'm going to use an example here so we could view it as we go over it. And let's pick a stock to look at. And I think let's take a look at Tesla stock today. So when you look up Tesla, you come to this summary screen, and what we're going to do is go to the options chain, which organizes the different options available to trade. And on this options chain, we have a lot of data and analytics to help us conduct research and look for potential opportunities or just get insights what's going on in the options trading. And here, when we look at the volume, we were talking about yesterday the looking at the trading volume from a high level. So we would aggregate the volume into total volume, trade option volume traded in a particular security. We could also slice it and dice it into total volume in a particular expiration. So over here, we see we have all these different expirations available to trade in Tesla. Let me close this menu here to expand it, but you could see here starting March 7th, there were over 1 million options traded in Tesla. And as you scroll down, these are other expirations organized by the shortest dated to the longest dated options. Okay. So what if we wanted to keep drilling down further? And once we open up a particular expiration, we see that we have these different option contracts. We have calls, we have puts. Calls are on the left-hand side, puts on the right-hand side. These are the strikes available in each of the options. And next to each option, we could also observe how much volume traded in that particular option. Right, so we could drill all the way down to where the volume is concentrated, or how much volume on a particular option is trading, maybe that even you might be interested in. So when we see the volume and we're interested in a particular option, let's say, I don't know, let's just say we're looking at this 287.5 strike on March 7th expiration. And if we're looking at the call, here's the call price, 415 bid, 425 offered, and we see that there are over 9,000 contracts were not traded in that particular option, 9,428. So we may want to see, well, what's going on there? How, what traded in that option? What time of day? How does that trading look like in this option? So you click on this on the volume, and it will load up this time and sales ticket for us. Okay, now we have the time and sales here, and some statistics up top and on the bottom to help us try to analyze the trading activity in this option. So here we could see that it defines which option we're looking at again. So we don't forget, it's the March 7th, 287.5 call. This is the trading summary. And up top, it tells us what did the implied volatility do or change from the previous day's level. So it's looking at the close of the implied volatility in this option, and then it's looking at the most current implied volatility and what is the change. So here it tells us it's down 7.5% right here, which on a relative basis is saying that the premium in the option, according to the options pricing model, is lower than yesterday. Okay, so the relative premium is lower because the implied volatility is down 7.5%. And we track that because we could break down the option value into different components, and we know that the option value could go up in price due to several factors. You know, it could go up in price because of its delta or because the stock moved in the direction favorable to that option. But also implied volatility plays a role, and that's the time premium, the component where traders are pricing in the forward-looking volatility. So here on a relative basis, we see that the implied volatility is down 7.5%. And the stock from the previous days is up 2.7%. So let's just take a look how that impacted the price of the option. So here, this is showing us what the option looked like at the end of the day previously and what it looks like currently. So here we see that and when we look at the option price, you know, we have a bid and we have an offer. So when we reference what is the value of the option, we look at the current market, the bid and the offer, because the trades themselves may not be current, right? You could have a trade that was like, you know, in the beginning of the day, didn't trade all day, but the value of the option changes because the stock changes, stock price changes, implied volatility changes, it decays. So how did the option look at the previous day, March 4th? We see it was 385 bid, 395 offered. So if we take the midpoint of that, it's worth around $3.90 mark to market. And we also see that the implied volatility of the bid was 79.2, and the implied volatility of the ask price is 80.1. Okay, so you have different prices, the implied volatility is different, right? The higher the price, the higher the implied volatility. So we could see the traders were willing to buy 79.2 volatility, willing to sell 80.1 volatility. So let's go now and compare it to the current. So we're closed now. So this is as of yesterday's close. We see that the price of the option went 415 bid, offered at 425. So that is a 30-cent increase, right? So it went up 30 cents. So the option value did increase, but we also see that the implied volatility was 73.3 on the bid and the ask 74.1. So the implied volatility is down. And why that's important is we see that even though the option increased in price, it did increase in price, and a lot of it could be attributed to the stock price, right? The stock price increase, it's a call, it increased. But on a relative basis, it actually still declined because the implied volatility is lower, which means if we gave this implied volatility, if we said the implied volatility remained the same, 79.2, let's say 79.2 instead of 73.3, this option would have been worth more. You know, I don't know, we could put in a calculator, but it would have been worth more than this $4.15. Okay, and that's what this is showing us, that yes, it increased due to the delta and the stock moving, but the implied volatility decreased. So some of that premium came out. And that's what this summary up top is letting us know. Now, here, this table, it's showing us the trades, the time in sales, the trades as they were reported on the Oprah feed. Okay, so that's the option pricing reporting authority. And when a trade occurs on an exchange, so we have different exchanges. You can see here, here's BATS, CBOE, PHLX. When an option exchange has a trade, it reports it to a central reporting authority. That's the Oprah. And then this is where we reference the time in sales. So here, why do we call it time in sales? Well, there's a sale, a trade, and then there's a timestamp to it. When did it happen? All right. So for example, just reading this from left to right, at 3:59 and 59 p.m., there's a trade in this option for 5 contracts. The quantity is 5 for a price of $4.15. In notional dollar value, it's $2,075. Because if we take 5 contracts times 415 times 100, that's the price, or that's the value of that trade. Then we could reference, okay, it traded at that price, and a lot of times we want to see where was the bid and offer relative to that trade price at that time. So you could see that the bid was $4, the ask offer was $4.15, so the trade happened right on the ask. Okay. What about the volatility? So keep in mind, the option price itself is moving around and changing to various factors. One is the stock price, one is decay. So, and then the other is implied volatility. So we want to see tracking the implied volatility because that's an important component to the option value. Because if implied volatility is coming in, saying that the relative value of that option is moving lower. Okay, if the implied volatility is moving up, the relative value of that option is moving higher, which indicates if there's pressure on selling or buying the premium or the forward-looking volatility. So you could see here, look, there are different prices. The same option is transacting while the price of the stock, is moving around. So we need to see what was the volatility of the option, okay, when this traded. So this particular, the volatility of the option was, implied volatility was 74. Okay, we could see the trade right before that was 73.8, 73.8. Here's a 73.6, 73.8, 73.3. And why is that important? Well, one is we could just eyeballing here and observing what is the trend in the implied volatility. Is it moving lower? Is it moving higher? Is it remaining stable within a certain range? So you can see here, it is remaining stable within a certain range. And now that we know the range, that helps us as traders assess the price discovery, the fair value of it, and where is it trading relative, to the lower or higher end of the range. Because if you're a trader and you're trying to buy something for a good deal, you want to try to buy it on the lower range if you can of the trading activity and sell it on the higher range. So if the trading range is between a 73.5 and 74.5 implied volatility, and you're entering an order and you're saying, okay, it's trading, a lot of activities going on there. Well, unless you really need that option right away, you're going to try to put in an order type, because you want a good quality execution, right? You're going to try to put in in order type based on your assessment of the fair value and where you buy it. Or maybe you could get it at fair value. But here we see that it's trading, just eyeballing it, above and below 74, it looks like to me. Okay. Over here. So that's referencing and we could even look at the bigger trades where here's a 60 lot traded at 73.8, 22, 73.8. So it gives us an opportunity to assess the relative value of that option. Here this is just referencing where the stock price was at the time of this trade. Okay. This over here exchange lets us know the exchange that it traded on. So if you do a trade, you get an execution, but it could have been on any exchange, it could have been routed somewhere away or so this is a way to see what exchange did this transaction happen. And sometimes we just want to see if there's a particular exchange that seems to have most of the volume or trading volume, or particular exchanges that maybe certain trading is going on where you have it at one particular vol or at a lower vol versus a higher vol, because it depends what you want to do. And if you're a trader and you're trying to get good executions and you're researching this, that becomes important, right? And I referenced the trading, the quality of the trades and the execution, because it's a very important part of trading. If you're not paying attention to that, you're probably never going to be successful, because that's just a important component of anybody's trading system. So even if you do good research, but the quality of your executions are terrible, then you're a very inefficient trader. It's hard to believe that you're going to be successful over the long term. So that's why keep mentioning that. So moving along, this is the condition of the trade. And the condition of the trade tells us in more detail about that particular trade and how it was executed. Okay, so this trade was auto executed. It just matched up in a matching engine on the bats. Okay, this one was a regular trade, auto executed, but let me just see to point some out. This one was a multi-leg trade. So a multi-leg trade is a little bit different. This trade involved another leg to it. So this wasn't just a regular buy or sell of this option. This option was tied to an execution of something else. It could have been another option or another two options. It could have been part of a spread or a different multi-leg, that had 3 legs, 4 legs, whatever it was. But this one was not just a regular single leg execution. Okay, so that's important when we're looking at these trades, because we could see how people are using these options. Here's another multi-leg trade. Okay, so those are the different conditions tied to that particular trade. And at the bottom here, we have another summary table of that trading activity. So here we see that the trades themselves, the volume, we see that there's 2,770 trades. Okay, so those are different. Each line is a trade. Okay, so for example, this trade at 359 involved 1 contract. This trade at 359.07 involved 20 contracts. So you have 2 trades, a different amount of contracts. right? So we had, what this is saying is there are two trades, and if we sum up these two trades, the volume is 21, 20 plus 1. Okay, so over here we have number of trades. Here we have the total volume, 9,428. So 2,770 trades, 9,428 contracts. That's the total volume. What about the dollar value of all these options? How much, in dollar terms, how much was transacted? And that is here, that's the notional, 3,269,545. So quite a bit. It's over $3 million worth of options traded in this particular contract. This open interest lets us know at the start of day how many open contracts there were, 2,977. So we could compare that, to the volume, just to see how active was it today relative to where the interest that was open in the morning. Then here's a price analysis. So over here, we see, well, what was the average price, the range, the high, the low? We could compare that to the last price here. So the volume weighted average price, that shows us the average price that this option traded at volume weighted. And what that means is, well, here's 60 contracts that traded at $4. Here's one contract that traded at $4.05. But 60 contracts is a lot more than one, right? So if we took the average just between 4.05 and 4, that would be 402.5. But in reality, there was more contracts traded at 60 than one. So we could take the 60 times 4 plus the 1 times 405, sum that up, divided by 61 to get the volume weighted average price. So this is the volume weighted average price on the day. It's $3.47. So we could see that it closed at a higher price than the volume weighted average price that it transacted. And it allows us to know that the price itself floated higher than where most of those transactions traded at. What about the day's range, the highest and lowest it traded? So this is the high of the day, $5.30. The low of the day, it traded at $2.20. So quite a large range there. Got over $3. And the last price is $4.15. So this lets us compare the last price versus the high, low, and volume weighted average price on the day. So similarly, this is price, and we talked about that the price of the option is moving around with the stock. So that impacts the value of that option. What about the implied volatility? Right? What about this implied volatility? Where did that trade? So here we have the volume weighted average volatility that it traded at, 74.7. That was the volume weighted average implied volatility that it traded at. The highest was 79.5. The lowest was 71.8. And the last trade was 74. Okay. So now we see the last trade versus the day's range and volume weighted average price, which shows that we're probably, we're not at the low of the day, traded lower. We're below the average, maybe closer to the lower than the higher end. So maybe it's trending, throughout the day trending lower, because keep in mind, we are down 7.5%, but that's based on the previous day's close. And the last price is also below that volume weighted average, kind of indicating that there's pressure on that implied volatility on that option. So I'm going to stop right there. I think we, went over this whole time and sales ticket.
Yeah, that was great, D. Actually, Rob gave a nice shout out talking about your skill set, how good you are. We have a bunch of new people on today, and he said yes. And if I knew half as much as Dimitri, we could all be as successful. His design of this site is unreal. No other site for retail, and I have found a lot, does this type of analysis. So that was a nice shout out from Rob. Thanks, Rob.
Thank you
Thanks
so much.
everyone for checking out. To the new chameleons who joined today, thank you. Remember, thumbs up, follow us. We try to do this every trading day before the market opens. Great job, D, as always.
All right. Thanks, everyone. Stay safe out there. Have a great trading day, and we hope to